So the next session is titled Private Company Strategies on Curating and Creating Liquidity Opportunities for the Option Holders. We have Vishnu from who is my colleague, and he is a senior product manager, and he would be taking this session for us. So would love to welcome Vishnu on the stage.
Thank you, Abhishek, and good afternoon to all. Oof, this is the most challenging session straight after the lunch. And, I always end up doing this. And I thought, what best to do some icebreaker event first. I let others come in, but I want to mention about liquidity. So the breakfast lunch is your ESOP policy, the ESOPs, the compliance, the tax, the whole shebang of ESOPs. Liquidity is that espresso which will keep you going beyond lunch and to the next day and to the more ESOPs and more policies. So I thought, this is not my joke. This is something which I asked ChatGPT to give me a joke so that I can start engaging you all. And this is what it said, and it felt very apt. So before I start, I want to generally, do a small exercise involving all of you. I want to just get a sense of how many of you are already in a listed company, which is already listed. Raise of hands. And how many of you are in a private company? Okay, fair enough. And how many of you are like in a pre-IPO, public but not listed? Fair enough, fantastic. So we have all the different categories covered. So I will start with so this is predominantly for, the strategies for liquidity opportunities for private companies. So we start with this in terms of why the private company liquidity is difficult or it's very sporadic. You see here, what you see on the left is a public company and the trading volumes vis-a-vis the primary capital raise, and same on the right is with the private. There's no comparison. Now, for any liquidity, it always needs a continuum. Without that, there's just too much of inefficiency for all the parties. And possibly the best way to get to the scale is technology. Of course, there are other parameters, but technology has to play a long way in helping us solve this. Now, if I look at the Indian market context past few years, if you look at the liquidity in the private space, there was a upward trend, but it went down, from 2021 with the winter which set in. It kind of trend is like tapered down. There is an anomaly there in 2023 with Flipkart and PhonePe. I would probably not call it as a true liquidity event as such, but the trends are not that great. However, there are some bright spots. And if you look at the private markets right now, a lot of funds are starting up with secondary funds. A lot of VCs are coming out of their VC fund and then starting a second. We hear a lot of this news, whether it is secondary funds, family offices, secondary dedicated funds, and in fact, even wealth outfits. We have done so many of these. We have seen so many of these in past year and a half that there's a lot of activity in the secondary side of things. Why do we need, or where does company wants to give liquidity? What are the main players? What are the criteria? Predominantly, first and foremost, is about employees. Either you want to reward employees who are there with you for long enough and want them to, you motivate them and want them to continue, especially the talent. We all know how important it is to retain the talent. Those are the two primary drivers for employee liquidity, especially. Apart from that, the other context is going to public, preparing yourself for IPO, pre-IPO. You want to, consolidate your cap table, or you want to do your pre-IPO planning, ensure that, you provide a liquidity, and then once you are listed, you're all set, and then, your cap table is well-rounded, and then you're in app space. So to put the same thing in terms of the stages of the company and what is the right time for liquidity. So I've categorized this from inception to series A to B. Almost very, very few companies actually looked for liquidity during that time because the value is not yet reached. They're still creating it. But as you move from series B to pre-IPO or before going public, That is one bucket or one category of companies where there is a lot of liquidity events happen, either through bringing in another fundraise, through primary fundraise, and then allocating portion of that to the liquidity event, or at the time of pre-IPO. That means you've gone public, you're still unlisted, going to go listing within a year or so. You would want to set up, you want to remove your ROFOs and all of that, and there is a liquidity event there. So if I can categorize these two as distinct buckets in which the liquidity events happen, taking from that, there are other considerations also. Within those two, there could be something about coverage. Whom do you want to give liquidity to? Are people who are active members and only then consider the people who are separated? Or you have certain strategies on which employee should get liquidity. So that is one consideration you take into for running a liquidity program. Or the frequency. Some companies want to have a cadence. They want to have a cadence of 18 months or 1 year or 2 years, up to 36 months. That period, they want to set up a liquidity event so that they motivate the employees to stay back. It is an employee retention tool. Also, it helps employees reach their dreams, because finally they would want to have a big lump sum. Like in the morning, we heard about how he was able to, because of ESOP liquidity, he was able to do nothing and do his own hobbies and other things. So we want to do that. Then there is the valuation bit, which, enough said, if they're either tagged to the previous round, or if the previous round was long back, there is a precedent of setting, the premium on what was previously done. And then, of course, the quantum, the skin of the game. Do you want to give all the vested option as a liquidity event, or you want to taper it off, give a percentage so that he tastes blood, and she can then, stay back for the next round, and then that is another. So these are some of the considerations for your liquidity. Based on that, what we have at, as part of Qapita Liquidity Solution, we bucketed into 4 things, because it's not just about one technological tool, which I give you this tool, use this tool, run the liquidity. But it's beyond that, because there is solutions, there are different ways of running your liquidity program, so which is be the solution, whether you want to do a surrender, you want to do an exercise, is it a share transfer, or is it some ESOP financing, some of those solutions around that. And given that, the design and structuring of your program. How do you want to structure it? Are you giving the liquidity out of the balance sheet? Is there a third-party investor coming in, or somebody else is mopping up, existing investor is mopping up, some of the structuring there? To do all that at a scale, if it is 1 or 2 people or 5, 10, maybe Excel and an Outlook is good enough. You can go around, take signatures, get done, and you're probably done in probably 10 days. But when you have scale, when you have 50, 100, 200, 300, or 1,500 or more, that's where you need the solution in terms of software, and that's where we have customized workflows which help you deal with all the participants, all the players in the event to execute your liquidity program. And finally, there is a syndication as well. This is not just about the money for the company to bring in, but also for employees to rely on when they have to pay for their exercise price or perquisite tax and so on. Moving on, if I can broadly categorize the liquidity events, they fall into 2 buckets. One is ESOP surrender programs. Essentially, this is where company pays either through their balance sheet, take a P&L hit, and then pay out of the balance sheet, or they link it to a primary funding and allocate some part of it and then raise it through that. So that is very popular, one set of program. On the other hand, you have exercise and share transfer. So that is slightly more complicated, that's slightly more involved, wherein employees with vested options exercise their options, convert them into shares, and immediately make the transfer to the incoming investor. So incoming investor could be an existing investor, existing shareholder, or a new incoming investor, or it could be third parties where they rely on our syndication to get on board, and then they sell the shares to them. So broadly, these are the 2 buckets or 2 types of programs which are run for liquidity events. Now, beyond this, what is the comparison? How does one fare with other? So in terms of surrender, your P&L takes a hit for sure. But in case of exercise, there's no P&L hit. It's an exercise and share transfer. But the companies will either bring in a new investor onto the cap table, or there's an existing investor who will mop up the existing employee. Similarly, in terms of execution, the surrender is straightforward. It's a simple execution completely within the company's control, pays out of P&L, set the price, and it's done. Whereas for exercise and a share transfer, it's slightly more cumbersome. So it's almost like a two-step process, where the first step is to exercise, the options are converted to shares, and then do the share transfer execution. And especially for companies which have gone public, they probably have already dematted, so the demat accounts have to be opened for employees, and then the share allocation, and then the share transfer, and so on. Similarly, pricing flexibility. In surrender, it's completely within the company's control, wherein they probably decide on it's their discretion. But whereas in exercise and share transfer, it is a negotiated price with the incoming investor. Similarly, the investor dynamics, if there is companies paying through P&L, there's probably no investor dynamics, but if it is through a primary funding round, it'll be through the preferential rights. But in the case of exercise, it'll be as simple common shares, which will get transferred to the incoming investor. Similarly, the proceeds of funding amounts are utilized in this case, or the P&L. There, it's much more efficient because either it will be through the incoming investor or either a new or an existing investor which will come through. So we talked about two distinct categories, if I could recall. One was Series B to pre-going public or pre-IPO. And then we also talked about the public limited unlisted who are pre-IPO planning, going into IPO planning. Now, for the Series B to the pre-IPO or going public, it is all about getting an investor who can mop it up, either existing or a new investor. But somebody who is planning to go into an IPO or a pre-IPO where they're going to go public, there exercise could play a very important role, because there is some pre-IPO planning which they have to do, we do. So some of the essentials, ESOP essentials, considering when you're going pre-IPO, are, you have to optimize your pool size, because once you go in being a public, so you want to make sure that pool size is maintained. Then you got to a structured liquidity program will help you a long way in terms of, going the pre-IPO round. Similarly, public limited companies have a flexibility of exercise window open, because once you give them to exercise and shares, employees can themselves also reach out and then do the sale, where company doesn't have to really worry about that part. Now, similarly, there's a secondary component which you can decrease, so that when you go into IPO, the secondary part is reduced and it will purely be on the. And of course, when the ESOP policy has to be ratified with SEBI regulations when we are going to IPO, all of that, these are some of the aspects which you consider, especially when you're going into IPO or pre-IPO of the company. Now, in doing that, why is the exercise beneficial before going IPO? And it all boils down to tax. So all of us know, in terms of ESOPs, they're taxed once at the time when they exercise, and then once they save. If we enable the exercise early, employees will then get the benefit of, the capital gains. So the long-term capital gains are much lesser than the short-term. In case of a listed company, the long-term capital gains is 12.5% without the indexation, based the latest one. The short-term capital gains close to 20%. But in case of unlisted private companies, the short-term is actually the income tax, which is the tax slab which you have, and it could go up to 35. I think the highest slab now with the new regime is almost 39%. I think previous one probably would be 42 point whatever with surcharges, but the long-term will be 12.5%. So this is really helpful for the employees who really have to go and take the benefit of the taxation and pay much lesser. Similarly, employees have an option, if they have to, exercise early, keep the shares, and then get the benefits out of, the long-term capital gains, instead of giving it as short-term. So in US, they also have in the West US, they also have the early exercise option, which really helps. But probably not so much in India as such, but that is one of the things which is definitely helpful in the US context. Now, to help with this exercise, especially for the pre-IPO public limited companies, public companies which are not yet listed, one of the things which we have enabled is a sell-to-cover mechanism. This is the mechanism where we help with the financing, or we help the employees with the exercise and the perquisite tax amounts. So in this flow, we start with the exercise, wherein exercise window is open, an employee chooses to set aside and go ahead and exercise certain number of options. Then she can then pick up an option to help with the financing, wherein whatever the amount he or she has to pay for both excise and the tax, or either of them, that can be negotiated, and then with the company and the employee, we set aside and we pay the employees that amount as a financing option. And post that, we pay the employees that, and employees pay back to the company. So that is taken care of. So it's not a debt on his books. He doesn't have to worry about it so he directly gets that money through us. And then company goes ahead, does the share issuance. The shares are in the demat form, especially for the public limited companies, and then the settlement is taken care. So it's in a way lot of benefits out of this for the employee side, wherein they don't have to worry about financing their options, especially for people who have a lot of these options, which have to both their excise price or even the tax based on their number of options which they have, that can be taken care. So why is it that does not make sense most times? Because there are very few institutions which give. I'm not saying they don't give, but they're very few, and they're really high rates. It can vary probably from 12 to 14% to almost up to 24, even 36%, especially if it is a private company. Having said that, there's still options. There's still people who take debt, and there's still options to go with that if there need be. And it also means that you are in debt. What if the IPO gets delayed? What if the liquidity is not right ahead? So it's always a risk if they are 100% certain of the liquidity, maybe yes, but if it is not, how do we recover that? So why does sell to cover make sense? It's immediate, it's guaranteed, and it is simple, smooth, and in one shot it gets done, and that load is off the employee, and it's, he can directly go ahead and not worry about that part as such. Having said this, I want to quickly walk through some case studies and transactions which we do and give an overview number which we have been doing past few months, past this year especially. So this is the broad number of liquidity numbers we have. So we have some 8,000 odd employees who have received liquidity this year just from us. We were able to fulfill this. I keep saying this, we are in the business of making employees rich. I have to correct it. I am not making them rich. The companies that they themselves made rich, we just enabled them to become richer faster using our platform, using our convenience there. We had to execute a whole lot of documents, especially when there is an excise and share transfer, there is an excise form, there is sometimes the SHA, there is SPA, or a whole bunch of these documents, supplying of this, annexure to this, CA 281, whole lot of documents. All of that being executed in a simple, easy, on a platform. Technology definitely helps and enables them to do much, much faster. So this is at a broad numbers, and this is at a glance of some of the companies which we ran. Anybody from these companies here? I don't know. I'm not sure if any of them here, but these are some of the companies which are running. Some of them have run the liquidity program. Some of them are actually getting into an exercise program because they are prepping for an IPO. So they want to give an opportunity to employees to get into the exercise window there. These are some more which we have done past few months. This is one specific case study I wanted to mention about a social e-commerce platform, wherein they had come to us with, Vishnu, we have very short window, and we have some 1,700 odd employees who want to participate, and we want to run it fast, and we want to run it quick, and enable this to complete. So we almost finished the whole exercise within 14 days, from the start when they contacted us to giving the window open and then completing and closing it. And it included a max cap. So they had a max cap on employees who did not want to go beyond a certain 2 crore or 1 crore limit, and based on separated and active employees, they wanted to set some restrictions. They were able to enable that and then close it. It was helpful for them because they had 14 different variants, 14 different buckets in which they ran the program, because they had certain promises for certain employees, there were certain separated employees, there were some active employees, they were of different plans. They had one plan where whole 100% was eligible, There were certain plans where there was only 35% were eligible. There were certain buckets which had only 50% eligible. And to track all of that for 1,700 employees and to execute within a short span, they really were happy, and then were able to do this within 14 days from the start to the end. Similarly, we have another one which is 430 plus employees, but the complexity here was it was exercised in a share transfer. And this had a trust, a direct route, and employees from 3 different countries: Singapore, Australia, UAE. And then they also had to ensure the transfer happened and the investor coming in was a foreign investor. So you had all of those FCTRS, FCGPR, all of that complication added to this. And they had, again, a whole bunch of these permutations and combinations, active, separated, percentage, and whole lot. And then the investor asking for certain specific documents for certain people, and then the SH1 and SH4, all of that execution all on the platform in one go. So I think that's pretty much what I have on my liquidity events. This is usually a 1.5 hour deck, and I was challenged that I should do it within half an hour. So I tried to rush through and get it done as fast as I could. I probably saved some time, and I'm happy to take any further questions on this from you. I know it's just after lunch, really tough, but I hope I poured in a little bit of espresso and, think of liquidity at your respective companies in this year or the next coming year for sure. Any quick questions or on any of the aspects? Definitely, yes. So, lovely. So the question was, elaborate on sell to cover scheme. So essentially what we realized is when we were running the liquidity programs was some of the companies where they were saying the employees had a lot of options. And when they had to exercise, either they had to pay high exercise price or a high tax. I mean, for one example, there was a person who was getting some total value he was getting was probably close to 3 crores, but he had to totally pay around 66 lakhs as tax and excise price. And none of the NBFCs or banks were willing to sponsor. So he was like, hey, I want to participate. How do I do it? We are close to getting into IPO and going public. How do I set it up? So that's where we kind of devised wherein we give the option to employees to contact us, wherein we give an illustration on, to figure out a mechanism wherein instead of you paying a debt and an interest on that debt, you give us a discount on the value, on the price which you are getting for the amount you need. And we help you with that amount and give you instantly without you having to take a loan and finish the transaction. But once you shares are allotted, you transfer us back that bit of portion of shares so that you are selling to cover the excise price and tax amount.
Liquidity you provide.
Correct.
And you charge a fee for that.
The fee is in terms of a discount, a negotiated price between us and the employee. And usually we are fair. We are not trying to hit him too high. So let's say 10 rupees is what he's getting for the fair market value, which he's getting the value from company. We probably say we'll give you 9 rupees. So that we can then sell it downstream, or we make the difference. And then a lot of them have opted for that option because he can't foot 66 lakhs out of his pocket. And then even if he was getting a loan, he was worried that he will not able to find a buyer post that, given that he's exercising.
And all this happens on your platform?
Yes. So he comes and expresses about the interest, and then one of us will call him and negotiate, and then we sign a SPA, and then we execute it, and then it goes on. So company is also in the know. So it's not that they are not in the know of this. Company is also in the know. They understand it. We take consent from them, and then employee does the.
Thank you.
Yeah. Thank you.
This is what company's responsibility and risk involved in this.
So
You are going to deal with the employee or company?
So usually we deal with the employee, but companies. So there are cases where some of the companies were involved, and they said, we will, be party to it, and we'll understand. And they were wanting to make sure the employee is not getting affected. But it's usually the employee and us who deal with it. And we give him the money based on that, excise price is given, and then he gets the shares, and then he transfers the shares back to us.
Okay, thanks.
Yeah, so there's one more question there.
Yeah, Vishnu, hi.
Yeah.
So with respect to the funding requirement, okay, is there an agreement between the employee and Qapita?
Sorry, with respect to the sell to cover.
ESOP, yeah, ESOP
Yes,
finance.
yes. So let's assume employee has to, pay 100 rupees for his excise and or either excise or tax or both, and he doesn't have the money. So he rings up and he talks to us. We first agree upon a price with which he will sell for us to give him that 100 rupees, and we sign a SPA with him. And then based on that, we give him the money, and then he deposits that money to company, and then money does excise. Company does excise.
So when the ESOPs are allotted, it comes to his demat account.
Yeah, the
So-
ESOPs are still allotted to him. It's not allotted to me. It's the share transfer which happens post that.
Qapita will not have any control over that, any lien over the ESOP account.
No.
So what about pledge creation and all that? Who would do that? Is there a pledge creation requirement here? The Qapita does it, or it's not required? It's not required. So it's between the employees. So the employee is responsible 100%. It's not the employer, right, to return the money.
Yeah.
It's the employee responsibility.
What we do is we do a SPA, and then we make sure he deposits his, the demat allocation, and then the EDIS is what is signed, and all the things are pre-filled, and then we do the transfer, and based on that, he supplies that back to us, and we deposit the shares back to us.
All right. So anyway, I'll connect offline with my queries. Thank you.
Awesome. Yeah. Any other questions? Yeah. So usually yes and no. Usually, if it is at one stretch, we will not. It's all about supply and demand for us as well.
Now, suppose if you open for next 7 days or 10 days,
Yeah.
the 10 days for the same tranche, same grant,
It will not vary.
it will not be the same only.
So if you do it over a period of 1 year, so the price in Jan might not be same in price in December. And this is especially true for the public limited unlisted companies. Not so much the private companies, but public companies which are still unlisted. It is for them we sponsor. Not so much on the private space as such, because then if it is public limited companies, we have means of selling them downstream if we have.
So the discount portion decision from company side, any role on this?
We hear a company and we ask them no-go zone and the price band and whatever, but essentially it is between employee and the employee and us. But we obviously keep the company in the loop, and then they can see the price at which we are selling or buying from the employees, and then their consent is always taken.
Okay, thanks.
Hi. In the illustration that you gave where the employee is getting stock at rupees 10 and you are taking it from him at 9.
Yeah.
So is it a correct understanding that on day one he's having a hit of 1 rupee?
Yeah, so he basically gets
So that's his cost of funding.
cost of funding, yes.
Okay. And the second question is, eventually once the company allocates shares to him in his demat account, those shares that he has agreed to sell to you will eventually move out of his demat to your demat?
Correct.
Understood.
Yeah. So let's say he's getting 100, of which he's sponsoring 30 of them. So at 30 of them, he will be selling to us, and he'll get 1 rupee less on them. And the remaining 70, he still gets at whatever 100 or 10 or whatever is his price. Yeah.
For this funding requirement, do you require NBFC license?
So we already trade in unlisted space. So it's more a SPA and a buyer and a seller agreement. So we're not financing with that. We are basically buying and selling from him. So we don't need. Any other questions? I'm happy to talk more on the whole sell to cover, because I seem to get a sense that seemed to be a popular questions, and it's a very interesting aspect which we which we came across, and it's actually beneficial both for employees, companies, and us. It's a win-win-win in a sense. So happy to talk more either one-on-one or follow-up calls with any of you who's gone public and yet to list. It'll work great for them, not so much for still being in private companies, because there could be ROFOs and all of that. So happy to talk more and discuss further. Yeah, so there's one more question there.
There is report or company balance sheet or profit loss statement or anything of that sort to understand the true valuation of the company or the share price.
See, we usually don't get into too much of documentation from the company as such, because company would have already set a price. They would have taken a merchant banker valuation report for their FMB, and there could be some precedent already in the market. So we will do our due diligence on what is the price and get a sense of that. And already there will be a price which is going to go for the secondary sale, which is happening anyway. Or the companies, if it is exercising, it will set some benchmark that this is the FMV at which we are selling. So we will use that as a basis, and based on that we go for. Thank you. All right. Any further questions? Yeah, there's one in the back there.
Can you elaborate a little more on the benefits to employees,
Yeah.
Due to this process of sell to cover?
Lovely. I think that's a good question. So essentially what happens is, I probably illustrate with an example in terms of numbers, so it'll be helpful. So let's assume an employee wants to exercise 100 shares, and for a benefit and ease of calculation, let's assume he will get 100 rupees, and of 100, 30 rupees is what he has to pay towards exercise and his tax. Now, if he doesn't have means of giving the 30 rupees, then he can't exercise because he will not go through. So for that 30 rupees, he contacts us, and we will decide on a price that, hey, instead of we'll give you a full 30 rupees, but we'll give you a discount. You give us a discount on that 30 rupees. So instead of you going and taking a loan and paying interest on that, we give you the 30 rupees, you will get 29 rupees worth back, and remaining 70 plus this 29. So he will probably lose that 1 rupee in the transaction, and then we get the 29 because we are funding that 30 back to him, and then he's able to go and proceed with the exercise. But more importantly, he doesn't have to go after finding the liquidity. If it's just an exercise, if he takes a loan and does the exercise, he still has to go and find a buyer, either to sell all of his 100 or to at least sell the 30 which he's taken a loan on. Otherwise, he has to keep paying interest. And what if the IPO gets delayed and that is not in his hands, or sometimes it's not even in the company's control? There are macro factors which can affect. So that risk is avoided for him. That challenge is not there for him. He's getting an instant money back without him having to spend anything and not taking a debt. So that's a big benefit for employees. All right. Sorry.
That, while I don't know whether I was actually attentive when you disclose the what you charge to the employee.
It's just an illustration. It's not a fixed price which I mentioned. I just gave a hint. So it will all depend on it's again a supply and demand. So given it's a public limited, we have a network of investors, wealth outfits, family offices, institutions. So we will see how we can place it. So basis that, we will go back to employee or the company saying that, hey, if this is the band on which if he can sell to us, we'll able to service him with that particular need.
So what is the range generally?
It's again very subjective. It depends on the company to company.
No, because the reason I'm asking is because the ESOP financing, it comes to you at 8%.
It'll definitely be much. It'll be much cheaper than that. It won't be in that
cheaper than the ESOP financing.
Yeah, for sure. Because it won't be in the sense of 14 to 36. Because ESOP financing
it is at 8%. ESOP financing.
It depends on company to company. Not every company will get at 8% for sure. So it depends on that. If he's getting it cheaper there, he might as well do. This is not a forced thing which we put it on employees. It is his option. If he still want to finance through ESOP financing, he can still go there. He can weigh in those options. It's not like we have to come to us as an option as such.
No, great. I'm just trying to figure out whether this actually makes sense to the employee, because employee would come to me and ask me what is the rate of interest.
Correct.
What is his outcome?
Correct.
for this
See,
transaction.
for usually private companies which are not, for listed or public companies which are not listed, it ranges from 12 to 36% is what we have seen. But if you're getting a better rate, for sure, it definitely makes sense. If that's the risk which employee will take. In terms of the exact band, there's no fixed band we go after. It could be even 1% or 2% based on the, supply and demand which we find.
Sure. Thank you.
All right. So for any further questions, you can reach out to me or Tanmay, Vikram, or Suchay, any of us, and we're happy to discuss further. Look forward to some of you running some of these events as Cell to cover pretty soon then. Thank you.